Imagine finding your dream home, falling in love with every detail, and then hitting a roadblock in the mortgage application process. It can feel disheartening, especially when the reason involves something called your debt-to-income ratio. If your debt-to-income ratio is too high, please know that this is a common situation and absolutely not the end of your homeownership journey. It simply means lenders see a higher risk, but there are clear, actionable steps you can take to improve your financial standing and get back on track for a mortgage approval. Your debt-to-income ratio, often called DTI, is a simple calculation. It is your total monthly debt payments divided by your gross monthly income. Lenders use this percentage to assess your ability to manage monthly payments and repay a loan. A higher DTI indicates more of your income is already committed to existing debts, making new loan payments seem riskier to them. The good news is you have several powerful strategies to address a high debt-to-income ratio. First, focus on reducing your monthly debt obligations. This often involves paying down credit card balances, personal loans, or even car loans. Prioritize smaller balances that you can eliminate quickly, which will free up monthly cash flow and immediately lower your debt side of the equation. Second, explore ways to increase your income. This could mean asking for a raise, taking on a part-time job, or even considering a side hustle. Every additional dollar of gross income can significantly improve your ratio. Third, consider adjusting your home buying budget. A lower home price means a smaller mortgage, which in turn reduces your potential monthly housing payment and your overall debt burden for the DTI calculation. Fourth, investigate different loan programs. For example, Federal Housing Administration, or FHA, loans or Department of Veterans Affairs, or VA, loans often have more flexible debt-to-income requirements compared to conventional loans. Finally, if appropriate, you might consider adding a co-borrower or co-signer with a strong financial profile. Their income and creditworthiness could help balance out your existing debt load and bring the overall ratio into an acceptable range. Did you know that some lenders also consider compensating factors when evaluating your application? These are positive aspects of your financial picture, such as a large down payment, substantial cash reserves after closing, a stable job history, or a high credit score. Highlighting these can sometimes help offset a slightly elevated DTI, showing the lender you are a strong applicant despite one particular metric. Ultimately, a high debt-to-income ratio is a signal to pause, strategize, and make some informed adjustments. By actively working to reduce your debts, increase your income, or explore different loan options, you are not just fixing a number. You are building a stronger financial foundation for your future homeownership dreams. This proactive approach empowers you to turn a potential setback into a successful step forward.